Have you ever thought about investing but felt you didn't have enough money? This is a common thought that deters many from taking their first step into the world of investing. There's a widely held misconception that investing is a game only for those with deep pockets, that it's an exclusive club for the wealthy. But let's debunk this myth right now. Investing isn't just for the rich. It's a financial strategy that everyone can and should take part in. You don't need a fortune to start investing. In reality, you can begin with as little as the price of a cup of coffee. Yes, investing does involve risks, and it's important to be informed. But the notion that you need a large sum of money to get started, that's simply not true. So, how can you start investing with little money? Let's dive into it. The first step to investing is understanding what it really means. Let's break it down, shall we? Picture investing like a garden. Yes, a garden. You plant your money, your seeds, into different pots, which are your assets. The hope is that over time, with proper care and a bit of patience, these seeds will grow into flourishing plants, giving you a return on your initial seed planting. Investing is essentially putting your money into assets that can potentially earn returns over time. You're not just saving your money under the mattress or in a cookie jar, you're actively putting it to work in the hopes that it will grow. It's like hiring your money as your own personal employee. Now you're probably thinking, that sounds great, but what exactly are these assets? Well, there are several types of investments you can consider. These are like the different types of seeds you can plant in your garden. First up, we have stocks. When you buy a stock, you're essentially buying a small piece of a company. You become a shareholder. If the company does well, so do you. But remember, if the company doesn't do so well, your investment could decrease in value. Next, there are bonds. Bonds are like IOUs. When you buy a bond, you're lending your money to a company or government for a certain period of time. In return, they promise to pay you back with interest. It's a bit like being the bank. Then we have mutual funds. Think of these as a basket of different investments. You're pooling your money with other investors to buy a collection of stocks, bonds, or other assets. This can be a great way to diversify your investment portfolio. Each of these investments carries its own level of risk and potential return. It's important to understand these factors before you start planting your money seeds. Now that you know what investing is, you're probably wondering where to start. Don't worry, we've got you covered. You don't need a fortune to start investing. You can start with what you have. And that's precisely the beauty of micro-investing. Micro-investing is a concept that's come to light in recent years, and it's all about making investing accessible and feasible for everyone, regardless of how much money you have in your pocket. It's like the saying goes, from little acorns, mighty oaks do grow. So what is micro-investing? In simple terms, it's an investment strategy that allows you to get started with just a few dollars. Yes, you heard that right. You can start investing with as little as $5. It's like dipping your toes in the investment pool without having to dive in head first. Now, you might be wondering how you can start micro-investing. Well, thanks to technology, it's easier than ever. There are numerous apps out there that offer micro-investing services, allowing you to invest your spare change into a variety of stocks, bonds, and mutual funds. These apps work by rounding up your purchases to the nearest dollar and investing the difference. So if you buy a coffee for $3.75, the app would round it up to $4 and invest the spare 25 cents. It's a simple yet effective way to start investing without feeling the pinch. Of course, like any other investment strategy, micro-investing has its pros and cons. The main advantage is that it makes investing accessible to everyone. It's a great way to get a taste of investing without committing a large amount of money. The downside, however, is that because you're investing in small amounts, it may take longer to see significant returns. But remember, investing is a long-term game, and every little bit helps. Micro-investing is a great way to start your investment journey, but it's not the only way. There are other strategies and methods you can explore, which we'll discuss in the next scenes. But for now, remember this. You don't need to be a millionaire to start investing. You just need a willingness to learn, a bit of patience, and yes, even a little bit of spare change will do. Another way to start investing with little money is by saving regularly. Now you might be thinking, oh great, another lecture on saving. But stick with me here because this little nugget could change your financial future. Think about it like this. Every dollar you save is a soldier in your financial army. The more soldiers you have, the stronger your army becomes. Regular saving, even just a small amount, can add up over time. And if you put those savings to work in investments, your financial army can grow even stronger. But how, you may ask? Well, It all comes down to a magical concept known as compound interest. This is the process where the interest you earn on your investment starts earning interest itself. It's like a snowball rolling down a hill, getting bigger and bigger as it goes. Let's break it down with a simple example. Suppose you save $10 a week. That's about the cost of 2 fancy lattes. Over a year, that adds up to $520. Now, if you invest that money at an average return of 7% per year, after 10 years, you'd have around $7,600. And that's not even considering the additional money you'd be saving and investing each week. The beauty of compound interest is that it rewards consistency and time. The more regularly you invest and the longer you leave your money to grow, the more your investment will multiply. So, start today. Even if you can only afford to save a few dollars a week, it's better than nothing. Over time, you'll be surprised at how much your savings and investments can grow. And remember, investing is not a get-rich-quick scheme. It's a long-term strategy that requires discipline, patience, and regular contributions. So, let's summarize what we've learned. Regular saving is a powerful tool for investing. It allows you to grow your wealth over time through the magic of compound interest. And the more consistently you save and invest, the stronger your financial army becomes. Remember, the key to successful investing is not just about how much you invest, but also how consistently you do it. When it comes to investing, never put all your eggs in one basket. This old adage is the essence of diversification, an essential strategy in investment. Now you might be wondering, what's diversification? Well, simply put, diversification is spreading your investment across different types of assets. You see, not all investments perform well at the same time. Some might be soaring, while others could be dipping. By investing in a variety of assets, you protect yourself from the volatility of the market. Let's break this down a bit further. Imagine you're at a potluck dinner. There's a table filled with all kinds of delicious dishes. Now you could fill your plate with just one type of food, say, mashed potatoes. But what if those potatoes turn out to be too salty? Your entire meal is ruined. But if you take a little bit of everything, some chicken, some salad, a roll, and yes, a spoonful of those mashed potatoes, you're likely to enjoy a well-rounded meal. That's diversification in a nutshell. In the investment world, your meal consists of different asset classes: stocks, bonds, real estate, commodities, and more. Each of these assets has its own risk and return potential. Stocks might offer high returns but come with high risk. Bonds, on the other hand, offer smaller returns but are generally less risky. Real estate and commodities offer a balance of risk and return. By investing in a mix of these assets, you're not only spreading your risk but also increasing your potential for returns. If one asset class performs poorly, others might perform well, balancing out your overall returns. This is the beauty of diversification. But remember, diversification isn't about blindly investing in as many assets as possible. It's about understanding your risk tolerance, financial goals, and investing accordingly. It's about making informed choices and keeping a close eye on your investments. Diversification is your best friend when it comes to investing. It can help you manage risk and increase your chances of earning returns. So, don't be the person who only eats mashed potatoes at the potluck. Spice up your investment portfolio with a little bit of everything. Investing is not a get-rich-quick scheme, it requires patience. Now that's a fact worth etching into your mind. When you start investing, especially with little money, it's essential to understand that the real fruits of your efforts won't show up overnight. Like a seed transforming into a mighty tree, your investments need time to grow. Think of it as a journey. You'll encounter hills and valleys along the way. Those are your market ups and downs. It's easy to get disheartened when the markets are down, but remember, it's all part of the process. This is where your patience comes into play. Sticking to your plan through the good and bad times is the key to long-term success in investing. Patience, combined with regular savings and smart diversification, will help you build a robust investment portfolio over time. Remember, investing is a marathon, not a sprint. So stay patient, stay invested, and watch your money grow.